Principles of finance, a la Shmup. Investment measuring sticks. All right, people. Well, over a long period of time, both company management and investing management have grown, sophisticated. In the same way a NASCAR team inspects engine heat, RPM, tire pressure, and so on, we have similar mathematical tools to inspect whether a company or an investing thing is doing well or, not. We'll come back to these tools in depth throughout the course, but let's start with some analysis of company performance. All right, well, to start, we'll make up a silly little income statement for the silly little lemonade stand. Lemonade stands are us. Right here. Revenues, net revenues, expenses, all this stuff right there. Got it? Okay, so let's just plow through this simple income statement and make a few observations that'll hopefully shine lights where things are dark in your brain. Well, how much did we sell a single drink for in 2020? $1. We sold 20,000 units and took $20,000 in revenues in the door. And using advanced calculus, that's $1 a drink. Got it? Why the $19,000 net revenue thing? What is net here? Net of what? What is net revenues? Well, we had a number of people paying us using a credit card. And Visa and MasterCard don't just have corporate jets for doing nothing. Somebody has to pay for them, right? So a good chunk of our business had us collect $1, pay a nickel to the credit card company, and then we keep 95 cents of that drink for ourselves. But that doesn't account for a full $1,000 taken off of gross revenues or total revenues. So what gives? Well, sadly, a number of people took a sip, spit out the fine formula lemonade, and, they demanded their money back. We lost the nickel of that cup when they did that, so a few $100 were just lost cups and lost drinkage. So that's why we get a net revenue number. It's 19 grand that we collected in revenues, not 20 that we billed for. Yeah, that works. Very clever. All right. And as a percentage of our profits, it was a big loss. Note that we spent $3 grand on our product, which we're defining as, cups and liquid. We could have included rent because, we need a place to sell lemonade, but it's just a street corner really in front of our house. So we're not going to include it in the must-have things to sell our product category. And usually that's the delimiter in what you'd include in gross profits. So we had $19K in net revenues and $16K in gross profits. All right, well, our gross profit margin then was 16 over 19. Nice high margin lemonade drinks. It would be rational if you wanted to keep $20,000 as the denominator. You could, in fact, take as an expense the Visa bills and the bad drink bills and stuff like that. And someday maybe you'll have zero lemonades to spit out or have 100% of your drinks paid for in cash. So if you wanted to say the gross margin was really 16 over 20 equals 80%, there'd be no rancor here in the hallways at the vaunted Shmup Wall Street corridors. All right, the key concept here is the difference between a profit dollar amount and the profit margin. Got it? Profit dollar amount was 16,000. The profit margin was 16 over 20. P.S. Margins are always a percentage. Remember that. All right, rent, labor, and marketing, they're all below the line expenses. All right, what line? The gross profit line. That thing right there. That whole above and below the line thing is actually a big deal in Hollywood as a weird sidebar here, weird as that sounds from Shmup, and no extra charge here for telling you about this. Profit participants, i.e. the movie stars, directors, and producers, are above the line players versus grips, gaffers, sound boom microphone holders, truck drivers, and people like that. Why? Because above the line players' compensation is usually variable, i.e. it hinges on how well or poorly the film does at the box office and beyond. You get profit participation when you're a player, right? But whatever, that's a sidebar. Moving on. We have $8K in pre-tax profits here from our lemonade stand. This is also called operating profits. Yeah, that's the profit we make from operating the business. Why report a pre-tax number versus just, ignoring it and reporting the net after-tax number? Because taxes vary from state to state and from country to country and from year to year, and most companies want to be comparable on an apple-to-apples basis, not apples to kumquats. All right, that line is also important as financial managers like the future you think about trying to find ways to pay less in taxes. Note that the operating margin of the company is 8K over 19K or 20K, depending on how you think about the real revenues realized, but to keep the math easy here, let's look at the $20,000 total revenues. We'll gross up our number and call the operating margin 40%. That's 8 over 20. All right. Then we have taxes. All right, well, we made up the 25% tax number, but it's a good proxy for what most corporations pay, other than Apple at least, who's based in Ireland, so they avoid an enormous amount of taxes. Good on them. All right, well, the bottom line, or net income of $6K, gives us a net profit margin, or net margin, of 6 divided by 20, or 30%. Very high profit margins for a drink company. Of course, once the kids manage to score themselves a liquor license and start churning outside mama's house hard lemonade, well, then the only thing higher than their margins will be their cleaning bill. Yeah, don't do that.